Start recording. All right. So warm greetings to all of you colleagues. Welcome to tonight's session and the FAC 3764. This is our lecture 4, video A. And what I'll be getting you guys introduced to in this particular engagement, it will pertain to the following: property, plant, and equipment, which is usually abbreviated PPE, right? Property, plant, and equipment. So one of the questions that one could ask themselves is, what is PPE? What is property, plant, and equipment? In simple terms, property, plant, and equipment refers to those assets which are owner-occupied. That is in terms of the IS 16. So in IS 16, it gives you a thorough description of what property, plant, and equipment assets really are. So these are owner-occupied assets, meaning to say assets that are used by the owner of the business in the course of running his or her business operations. That's what we call owner-occupied assets. So what are those examples of such type of assets that you find that are owner-occupied in nature? Right. So this would include, for instance, land, buildings, vehicles, machinery or crane, equipment, plant, just to name a few. So all these are typical types and examples of property, plant, and equipment assets. Very, very, very important to take note of this. And when we are talking of property, plant, and equipment, another important thing that you need to bear in mind is that these are long-term assets, meaning to say these assets they have a useful life of a period longer than 12 months. That's what it means here when you are saying these are long-term assets. So their useful life, it's above 12 months. It's above 12 months, right? It's very, very important to take note of that. Now, obviously, majority of these assets that you see there, they are depreciable assets, but with land, with an exception of land, obviously, because land appreciates in value over time. So what you would expect to see with land, you would expect to see it increasing in value. So how do we obviously measure or assess the change in value of land? Normally, that's where revaluation process comes into the picture. So you discover in the context of a question, they would mention that the value of land when we acquired it, it was perhaps maybe 500,000 rands, maybe in 2019, for example. And we are sitting maybe in 2024 financial period that is ending 31st of December, 2024, right? So if the property was bought, if the land was bought, say in 2019, 2019 might be slightly far. Let's just say maybe 2022, for example, and it was acquired for 500,000. By the time you get to the 2024 financial period, what you discover is because of time differences, the value of property would have to be revalued. All right. So we call that the revaluation process, right? It's just another form of a costing model that is used. So it's called revaluation process. So with revaluations, that's where the concept of revaluation surplus emanates from. The process of revaluation surplus. So the revaluation process, that's where you derive the revaluation surplus or a revaluation deficit. It depends with the change in value of the property. So if ever the asset was acquired for 500,000 rands in 2022, and now you're sitting at the beginning, maybe say the 31st of December 2024. Now the value of the land is 800,000 rands. Notice there's a difference in terms of the value of the land. Initially in 2019, I think, well, doing this, let me be writing it on the screen so that it can make more sense. And the concept I'm just trying to bring to your attention, it's called the revaluation process. Right. It's not a new concept at this third year level. Why I'm saying so, because at second year you were introduced to this. So with revaluation process, what happens is definitely you need the carrying value of the asset, and you need to measure that against the market value of the asset today. So that's literally saying the value of the asset today. So if ever in 2022, right, we'd acquired that asset, let me just put these details just right at the bottom. So in 2019, suppose we had acquired, 2022, sorry, we'd acquired the land for 500,000 rands. And now we are sitting at 2024, and what is happening is now the value of the property has now increased to 800,000 rands, right? So the 800,000 rands there that you're looking at, that's the market value of the land today. The 500,000, it's almost more or less equivalent to the carrying value of the asset as we're looking at it from the date when the property was acquired, or the purchase price in this case, to be more precise. Right. So now, if I look at the differences between the two, if the market value is higher than the carrying value of that asset, you would have what we call a revaluation surplus. So this happens when the market value is greater than the carrying value of the property in question. But then if ever the market value is lesser, which is under rare cases because land usually appreciates in value, all right, you would have what we call a revaluation deficit. That is if the market value is lesser than the current value. But in this context, what we are having is a case whereby the market value is 800,000 rands, which appears to be greater than the carrying value of 500,000 rands, leaving us with the revaluation surplus, which is the difference between the two amounts. And the amount is going to be 300,000 rands. So that amount that you're looking at here, that's the revaluation surplus. And you may have to disclose the revaluation surplus in the notes in the property plant and equipment note. So that's another thing that I wanted to introduce you guys to here. It's not new again, but it's something that you need to be able to do, because in the context of an exam, they would expect you to be able to draft the property plant and equipment note. Very, very important. So there's a typical example that I'm going to take you guys through in one of the tutorial letters that I've shared that I'm going to share on the PDF platform. So what I'll do is I'll be taking you through these examples so that you can practically understand where these calculations are coming from, where these figures are coming from. So I'm going to endeavor to take you through one of those practical examples so that you can be able to see how these calculations can be derived. So I'm going to quickly open the PDF, and so that I can show you the question, obviously, that we're going to discuss, so that you understand where those calculations that I'm indicating here on the Word document, where are they coming from, So, but essentially for format purposes, in your property plant and equipment note, which is usually note number 5, all right, what you discover is on the columns there, that's where you indicate the names or the titles of the assets that the company have that fall within the group of property, plant, and equipment. And then on the other side, which is in the first column usually, but with the first rows or with the raw fields, this is where you'll be indicating, for instance, carrying value at the beginning of the year, and then followed, of course, by the cost price, and then the accumulated depreciation, which has to be subtracted from the cost price in order for us to get or to obtain the carrying amount at the beginning of the year. So everything that you are seeing here about the carrying amount, the cost price, carrying amount at the beginning of the year, the cost price and the accumulated depreciation, all of these things, they pertain to opening balances. So everything you're looking at here, it has to do with balances that existed in the prior financial period that we are now using in our property, plant, and equipment for the current year as our reflective opening balances. Very, very important. But anything from movements, under movement section, it has to do with what transpired from the beginning of the financial year, the current year in that sense, up until the end of the financial year in question. So that's what you discover under the movement section. So you put several items there. There's what we call additions or acquisitions. That line item, it pertains to a case or a circumstance where the organization have acquired new assets. So you would have to indicate the value of the property or the asset that has been acquired in that column. Then, of course, it's also possible that you might have disposals. You might decide to sell assets during the course of the year. Now, if you sell assets or dispose of certain type of assets that you owned, what you need to do is you need to reflect them under the line item disposals. But what you put or what you input in the column for the asset that has been disposed, you have to put the carrying value of that asset on the date of sale. I repeat, anything that you put under the line item disposals, all right, for an asset that is being disposed, please make sure that you put the value at its carrying value or the carrying amount on the date of sale. So it's at carrying amount on the date of sale. So it's very important that as you go through information in the question, you are able to ascertain what happened in terms of that asset that was sold. Get the details right and be able to compute or calculate the carrying value up to the date of sale for that asset that has been sold. So there's a calculation that you'll be expected to do in that respect. Then, of course, you would also have depreciation for the year. All right, there's a line item depreciation. And notice that for the column for land, because land does not depreciate, you would not put the depreciation value for the column for land. But for the rest of the assets, such as buildings, furniture and fittings, motor vehicles, machinery, those are depreciable assets. So we are expecting to see the depreciation values or the depreciation amounts being reflected under the line item depreciation. And then in the context of revaluations, which I was explaining to you earlier, when you do a revaluation, it can result in a surplus or it can result in a deficit. All right. But in the context of our question, it resulted in a surplus. Why? Because the cost price, all right, or the carrying value of the asset at the time, it was actually 100, so it was 1 million. And then the revalued amount, which is equivalent to what we call the market value, was 1.5 million. So the difference between the two is where you would see, for instance, that revaluation surplus of 500,000. That is mostly under the column for land, because land appreciates in value. Very important. Notice even under accumulated depreciation line item, you don't see anything for the column for land. Why? Because it doesn't depreciate. Now, so everything in blue or in light blue, it's basically indicative of movements that transpired, notice, during the course of the financial or current year, which is from the beginning of the year up until the year of that organization in context ends. So it's from the beginning up until the end. That's what you put under the movement section. So it's very important to pay attention to the details in terms of dates so that you can be able to account correctly for certain transactions in the context of the question that you come across. Now, at the last part to the property, plant and equipment note, it has to do with what we call closing balances. So you would have to determine, for instance, the carrying amount at the end of the year. Then, of course, the cost price at the end of the year. And then lastly, the accumulated depreciation at the end of the year as well. Notice all of these are closing balances. So this is like what we determine at year end. Very, very important. Which, if we do the property, plant and equipment note for the following financial period, this is the information that you will be conveying at the very beginning of your financial period. So that's what you'll be putting as your carrying amount at the beginning. I'm talking now if we're supposedly looking at the next financial period. So this 1.5, it will be the opening balance in the following year of that organization. So now, very important with regards to the closing balances, there's a line item titled carrying amount at the end of the year. Very important line item. Why? Because that's the line item that we need to totalize in order for us to determine what to disclose in the statement of financial position. So you have to add the 1.5 plus the 2,260,000 plus the 775,312, 175,000 plus the 561,000. Remember, all of these are carrying values for the different respective assets of the organization in its property, plant, and equipment note. So you need to aggregate the carrying values at the end of the year. Why? Because that's what you disclose. The total is what you disclose in the statement of financial position as property, plant, and equipment. So what do I mean? If I am to draw here, the statement of financial position, right? Which is usually what they would ask you. They would expect you to, and probably they'll most likely ask you to just disclose the asset section of the statement of financial position as at, all right, maybe say it's December 2024, right there. So what you do is, in the property, so in the statement of financial position, it has got different sections, right? So you've got the asset section, you've got the equity and liability section as well. But while we are looking at assets section, right? So this is like the final column, obviously, where you'll be disclosing the amounts. So here you're gonna have your assets section. Right, and under your asset section, you would have non-current assets somewhere there. Under non-current assets, that's where property, plant, and equipment would have to be disclosed. That's where even fixed deposits, if any, would have to be disclosed. If there's any financial assets, this is where they'll need to be disclosed, as well as goodwill. This is where it will have to be disclosed. I'm talking about non-current assets right there. But my special focus, because I'm dealing with property, plant, and equipment, my emphasis for now is on that particular line item. So you may not need to worry so much as yet about these other line items. Of course, yes, it forms part to the property, plant, and equipment. Then, of course, here, you would have a total. Total non-current assets, and then followed by the current assets. with your current assets, usually it's made up of things like inventory, trade, and other receivables, just to name a few. All right. Trade and other receivables, it also covers your trade debtors, even prepaid expenses, just to name a few, guys. It forms part and parcel of your current assets. And then, of course, you get total current assets right there. And lastly, you get total assets. Okay. Before you can even go to equity and liabilities. I'm just showing you things that you'll be expected to do when you get a question about property, plant, and equipment. Normally, they would request you to draft a statement of financial position for a particular organization at a particular financial period. So my focus, like I said, is on this property, plant, and equipment. So where is this value coming from? So it's gonna come from the note that you would have calculated, that note 5, or the note property, plant, and equipment that I was showing you guys earlier from this. So this note, this is where your value that you are supposed to be disclosing here in the statement of financial position, this is where that amount would come from. But which amount is it? So to make it easy, I'm just going to cross-reference, and I'll put A next to that value so that you know what line item to use. So you see this carrying amount at the end. Since I've already cross-referenced it as A, I'm just going to put A over there so that you guys can be able to see the connection. So when I'm saying A for the line item carrying amount at the end of the year, I'm saying you need to take the total for that particular row. So you're saying you're adding the 1.5, the 2 million, 0.2, 60,000, all these amounts in yellow. We have to add them together in order for you to get the amount or the value that you're going to disclose here as property, plant, and equipment amount. That's how it's done. Okay. So in the context of an exam or a test, right, usually they would ask you to do the statement of financial position, but you would know that as much as they want maybe the asset section of the property planning, the asset section of the financial statement of financial position, all right, most of your marks would come from this computation that you have done here. All right, so this property planning equipment note, it would form part of your calculations. All right, it will form part of your calculations. Whatever you're just putting here, it's just a transfer of your calculated amount from the property planning equipment note, and they will give you what we call format marks, or what they call principal marks. So for you transferring that amount from the property planning equipment and putting it here in your statement of financial position, and whether the answer is correct or incorrect, you still get a mark, and we call that a principal mark. They check that when they are marking you. So that's one of the important things I thought I should point out to you guys so that you can pay attention to this. Right. So now that I have introduced you guys to this, I want to take you to the, there's a question I've shared on the group, okay? There's a question that I've shared on the group. I'm going to open it so that we can have a practical approach to it. So I'm going to quickly open the question. So it's a self-assessment question anyway in your study guide, but I just thought it's important for us to go through it together. So I'm going to switch screens and begin to discuss the question with you guys. Okay. Right. So it's a 35-mark question. So let's have a look at it, and then I would share with you what needs to be done over there. So the best point of approach or best point of departure when you get questions, whether it's in a year test or whether it's in a context of an exam, is always to start off by looking at the required section of the question. So they're asking you to disclose the following notes to the annual financial statements of Pecklite Limited for the year ended 30 June 2022. For how many marks? For 35 marks. Notice what is the first note that they want you to do? I just want to quickly save something here. Okay, great. It's saved now. So the first note they want you to do is the property plan and equipment note. And notice that they say a total column is not required. And then the second note that they want you guys to do, it's called the deferred tax note. And they said only for the manufacturing, property, and machinery. Indicate in your note whether the deferred tax balance per asset is deferred tax asset or deferred tax liability. Okay, I'm going to still teach you about this concept of deferred taxation. It's actually topic 2 according to your prescribed text. So, but I'm going to take you guys through that as soon as I'm done with this concept of PPE. I'm going to take you guys back to this aspect of deferred tax, and then we'll look into that note, the deferred tax note. But for now, what I'll focus on is the property, plant, and equipment note. Now, there's a note here that they've put for you. Your answer must comply with the requirements of International Financial Reporting Standards, that is the IFRS. Accounting policy notes are not required. However, you are expected to show all your calculations, round off all the amounts to the nearest rands. And then they said ignore comparative information. Now, the question now comes, when you have a question like this, yes, we have read through the required part. We understand what is expected of us. So we have understood what is expected of us according to the required section. So that's your starting point. What is the next step to do? The next step is to go through the information to identify the property, plant, and equipment assets. That's step number 2. So I'm going to write this down because you need to follow these things systematically in order to be strategic when you're answering the question. So the first point of departure, so I'll call that step 1. Read the required part. Step 2, identify the type of PPE assets in the given scenario. That's what I'm about to do now. And then step number 3, draft the PPE note in your answer book. That will be the next thing to do. All right, step 4, it's just basically being able to account for each asset systematically. And we're going to do that today, practically, just so that you can see what is happening. So step 1, we've already done that. Step 2 is what I'm about to do now. It's to identify the type of the PPE assets in the given scenario. So you don't have to be intimidated that the case study looks very long or what. It doesn't really matter. What matters is, are you identifying the relevant information that you would need to use? So now let's look at this. Pecklite Limited. Notice by virtue of the naming of the company itself, I can already see that it's a public company, right? But that doesn't really matter much in this case, right? It's a company that manufactures biodegradable packaging. The company is a 30th of June year end. The following details are available on certain assets of the company. Now, I want to check before I even continue, according to the required part one more time. What is the financial period that we are concerned with. It's one of the other important things that you should be able to do as you read through the required part. So as you read through the required part, also identify the financial year or the current year in question. All right, you must be able to identify the current year in question. So if it's ending the 30th of June 2022, it should have began somewhere prior on the 1st of July 2021. All right, for the financial year to end on the 30th of June in 2022. So this is our current year, right? So anything that will account for under the movement section in the property plan and equipment note, it has to be anything that transpired between the 1st of July 2021 and of course 30 June 2022. So that's what we need to pay attention to as we go through the context of the question. So now if I go to the case scenario, let's see what have they given us. So they are saying the manufacturing plant. So let's see what's happening with the manufacturing plant. Already I can see okay, so manufacturing plant, it's one of the assets. Number 2, I can already see machinery, it's another asset. I can already see number 3, delivery vehicles. That's another asset. And then if I go through the accounting policy, it should be able to give me some little bit of detail if perhaps there might be any other assets that we may not be aware of. But anyways, I'm expecting to get some more details from the accounting policy in terms of, for instance, how they are dealing with depreciation and all that. But nonetheless, let me start with the first asset, then we go to the other one in that order. But already I can see that we've got 3 groups of assets so far. So, but let's start with the first one, manufacturing plant. So a manufacturing plant, this is the a location where the production is taking place, right? So obviously it should be made up of what? Land and building. I'm talking of the plant. So Parklight owns, notice they own a piece of land which was developed into a plant, which is used for manufacturing biodegradable packaging. Already I'm seeing something. Before I even go far, this manufacturing plant, it's made up of 2 things. There's land, and then there is the plant side of things. So the plant side, it's almost like the building anyways, you know? Right. So, okay, so the land was purchased on the 1st of July at a cost of 565,000. Construction of the building of the manufacturing plant commenced on the 1st of October 2018. Remember, I told you plant in this case is almost like the building structure which they are using to perform the production. So in this case, as I'm looking at manufacturing plant, I'm already seeing what makes up the manufacturing plant in this case. There's a land portion, and then there's the plant or the building portion. So when I do my property plant and equipment note, I need to have a column separate for building and then the other column separate to reflect for the plant or the building structure in this case. Now, the following costs were incurred with the construction of the building of the manufacturing plant. So number 1, there's a site engineer and site preparation fees amounting to 87,895 and 139,800 respectively, paid in cash on the 1st of October 2018. Building materials amounting to 753,250 were purchased and paid on the 1st of November 2018. The architect fees were paid in cash during the construction phase, and they amounted to 350,000 rands. The building of the manufacturing plant was available for use as intended by management and brought in use as on the 1st of June 2019. That's a very important date to pay attention to. 1st of June 2019. That's when we could now be eligible to use the property, or in this case, the plant. So from that day onwards, going forward, that's when you can begin to account for depreciation on that particular building. So in video B, I'll be discussing further about this. So you use the same link, guys, to connect, and then we'll take it further. Thank you. Okay.